Hey everyone, welcome back to Corporate Decoder, where we unpack the mysteries of corporate filings. And today we're diving into ContextLogic's latest report, a real roller coaster ride of financial twists and turns that might leave you asking what just happened. So what's the big story here? Well, it looks like ContextLogic is undergoing a massive change after selling off its main Wish platform. We're talking about a company that used to be all about connecting buyers and sellers globally, now trying to figure out its next move with the cash it got from that sale. Let's jump straight into the numbers. If we look at the balance sheet as of June 30, 2025, we see they have cash and cash equivalents of about $27 million. That's down from $66 million at the end of 2024. They also have marketable securities, which are basically things like government bonds they can easily sell. And that number has jumped significantly from $83 million in 2024 to $92 million now. This suggests they're holding onto a lot more cash and investments after selling off their core business. Now, this is where it gets really interesting. Remember that big asset sale we mentioned? It happened on April 19, 2024. Because of that, when we look at their revenue for the 3 and 6 months ended June 30, 2025, it's zero. That's right, completely zero compared to last year where they had $7 million in revenue for the 3-month period and $43 million for the 6-month period. This is a massive drop, 100% drop to be exact. This isn't a sign of bad business performance though, it's a sign of a major business transformation. They sold their operating business, the marketplace and logistics services. So naturally, the revenue from that is gone, period. This is a massive drop. 100% drop to be exact. This is a massive drop, 100% drop to be exact. This isn't a sign of bad business performance though, it's a sign of a major business transformation. They sold their operating business, the marketplace and logistics services, so naturally the revenue from that is gone. Following that logic, their cost of revenue also went from $6 million in the 3-month period last year and $36 million in the 6-month period to zero. This is to be expected when you sell your entire operating business. But a company still needs to pay its bills, right? So even without selling products, they have general and administrative expenses. For the 3 months ended June 30, 2025, these costs were $7 million. That's down from $13 million in the same period last year. The report explains this decrease is partly because the operations they sold had about $4 million in severance costs related to everything. For the 6 months ended June 30, 2025, these expenses were $13 million, way down from $35 million last year. This big drop is again mainly because they sold their old business. Even with the sale, they're spending money on things like employee costs, including stock compensation, figuring out what to do next with their cash and legal fees. Now, what's going on with their money sitting in the bank? Well, their interest and other income net was $2 million for the 3 months ended June 30, 2025, which is the same as last year, but for the 6-month period it went from $2 million last year to $4 million this year. This jump is because they had some foreign exchange gains that affected last year's results, and without those this year, the interest income is more apparent. They're essentially earning money on the cash and investments they have left after the sale. Remember that asset sale back in April 2024? The report shows a $4 million gain from that sale for both the 3 and 6 month periods this year. That makes sense because the sale itself happened last year, so the gain is recognized then and they're just reporting it again for comparison. When it comes to taxes, there was no provision for income taxes in this current period. Last year they did have a tax provision, mainly related to withholding taxes on some dividends paid out. The big decrease is linked to selling off their business and foreign operations. And what's the bottom line? Their net loss attributable to common stockholders for the 3 months ended June 30, 2025 was $6 million. That's better than the $13 million loss it had in the same period last year. For the 6 months ended June 30, 2025, the net loss was $13 million, a huge improvement from a $72 million, a huge improvement from a $72 million loss in the first half of 2024. This is mostly because they had massive operating losses before the sale, and now they're just dealing with administrative costs and investment income. Looking at the shares, the number of shares outstanding has also increased slightly. For the 3 months ended June 30, 2025, their weighted average shares used for calculating loss per share were 26,633,000, up from about 25,858,000 last year. This is likely due to stock-based compensation and the settlement of restricted stock units. Now, there's a bit of a complicated piece here involving Redeemable non-controlling interest. Basically, they brought in an investor for about $75 million in March 2025, and this investor has certain rights, including the ability to redeem their investment under specific conditions. For now, this interest is sitting as a separate part of their finances, not quite equity and not quite debt. As of June 30, 2020, 2020, 2020, 2020, 2020, 2020, 2040, 2020, 2020, 2020, 2020, 2020, Reforger is averaging $6 million, showing some growth from the initial investment due to accrued distributions and accretions. This isn't a typical thing you see from companies that are just operating normally, but it makes sense in the context of a company restructuring and bringing in new capital for future ventures. Venture trade equity and not quite debt. As of June 30, 2020, 2020, 2025, this interest was valued at $76 million, showing some growth from the initial investment due to accrued distributions. They also mentioned a big reorganization that happened after the quarter ended on August 7, 2025. This is where ContextLogic Inc. became a subsidiary of a new holding company, ContextLogic Holdings Inc. They also voluntarily delisted from the Nasdaq stock market and moved to the OTCQB venture market. This usually means they're trying to cut costs and perhaps streamline things as they figure out their new business direction. They also closed a letter of credit that was related to a previous lease, getting back about $1 million in cash. Let's talk about risks. One major risk they highlight is counterparty risk with the buyer of their assets. If the buyer doesn't fulfill their obligations from the sale agreement, ContextLogic could face losses. They also mention a letter of credit tied to a former lease. If the buyer messes up their lease obligations, ContextLogic could technically be on the hook, even though the buyer agreed to take over. It's a bit of a hope for the best, prepare for the worst situation with that old lease. And about that move to the OTCQB venture market. This isn't usually a good sign for investors. It often means a company is facing challenges in meeting the requirements of a major exchange, like Nasdaq, or wants to significantly cut costs associated with being listed. This can lead to less trading activity, less analyst coverage, and generally make it harder for shareholders to buy or sell their stock. It's a signal that things are changing and not necessarily for the better in terms of stock liquidity. So what's my take on this? ContextLogic is in a massive transition phase. They've sold their old business and are essentially a holding company now, holding cash and investments. Their future depends entirely on what they decide to do with that money. Will they acquire a new business that utilizes their significant net operating losses, which are basically tax credits? That's the big question. The fact that they've gone from a major tech platform company to potentially a new venture or an investment vehicle is a huge shift. The delisting and move to OTCQB suggests they're trying to manage costs tightly as they navigate this new strategy. They have the cash, but finding the right business to buy and successfully integrating it all while managing their tax benefits is a monumental task. The risks are high, but the potential upside if they make a smart acquisition could also be significant. It's a high-stakes game of finding the next big thing while managing their resources very carefully. What do you all think about ContextLogic's situation? Are they setting themselves up for a comeback, or is this a sign of a company searching for direction? Let me know your thoughts in the comments below. If you found this deep dive helpful, give this video a like and subscribe for more corporate deconstructions. Also, don't forget to join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.